Hey everybody, one of the types of stocks I get asked about the most since I am a real estate investor are mortgage REITs. Now we're going to talk about kind of what's wrong with mortgage REITs as an investment from my point of view. But we're also going to get into two dividend stocks we like better. Tyler is joining me today. Before we dive in, please take a look at the link you see on your screen, fool.com/Frankel. You get the top 10 stocks to buy right now from my sponsor, The Motley Fool. It's a great way to support this work we're doing on YouTube. Again, that is fool.com/Frankel. So let's start with why we don't like mortgage REITs that much as an investment. They're, for me, and Tyler can kind of piggyback on this. He might even be more negative than I am. Who knows? Let's just say. Um, they're purely income plays that are designed to fail over time. Is kind of the best way I could say it. So the way mortgage REITs work, and there's a lot more to it than this, obviously, but what they'll do is they will borrow money at low short-term interest rates, buy mortgages that pay higher long-term interest rates, profit from the spread, and borrow a lot of money in order to really boost their returns. The problem with that is it's a business model that's designed to work well when interest rates are stable. Look at any 5-year chart of interest rates over the past 50 years. Interest rates are not stable. So when interest rates fall, you get a lot of people prepaying their mortgage, refinancing, so your mortgages go away. Your business starts to dwindle. And when interest rates rise, those 30-year mortgages you bought are still paying the same yield, but the short-term interest rate that you have to pay to maintain them rises dramatically. And that spread can even, narrow completely or even go backwards. Which can kind of cause a fire sale of your assets. So, Tyler, I think I already know the answer to this question. Do you own any mortgage REITs in your portfolio?
No, I do not. There is a certain like appeal because every once in a while you look at it and go, you'll see something like, I don't know, Annaly Capital Management, as an example, with a dividend yield of 13, 14, 15%. And you're like, man, a lot can go wrong with a 15% dividend yield, right? But even with that in mind, it is still a business that has struggled to, even under what we would call, I would say, ideal conditions for uh, for mortgage REITs, basically was like post Great Recession to arguably like 2020, where short-term borrowing rates, because that's what all of their borrowing is. They borrow short, which is a lower interest rate, and then buy long, which is buying long-term mortgages at 30-year, 15-year mortgages, something like that. It In this like 10, 12-year period where your borrowing costs were the lowest they're arguably have ever been, and probably will be. Like, I don't know, is there ever going to be a time where we're going to have short-term interest rates at less than 0.5%? I doubt it. But over that time, we saw Annaly Capital Management cut its dividend multiple times. Now, sure, I mean, we can explain away a lot of it. Oh, 2010 to 2013, there was still a lot of defaults, and so you had a lot of lost loans. Or 2018, we started to see rising capital costs again, and then 2020, you can keep making excuses, but every single 2 or 3 years, there's an excuse and why there's a dividend cut. And if you look at Annaly Capital Management, we were talking about a dividend in 2010 that was almost close to $3 per share. And today it's about 65 cents on an annualized basis. So you're talking about a business that I'm not. I'm not wholly against the idea that maybe in a very slowly rising interest rate environment, or a flat or a ever so slightly declining, that maybe the business could stabilize for a while and we could see some extended period of continuous dividend payments. But we haven't seen it ever with this business. And Annaly's not the only one. You've seen it with numerous other mortgage REITs, basically in this business, do the exact same thing. And so every single time you look at it, it just, there hasn't been that prove it sort of moment for me that says that this time is different and all of a sudden this 15% dividend yield is actually stable.
Yeah, so let's talk briefly about a couple of alternatives if people are looking, because, you know, I'll start with mine. And I picked EPR Properties, ticker symbol EPR. The reason for that is now, Tyler, I know out of like the 20 dividend stocks in my portfolio, you like 18 or 19 of them better than EPR. But the reason that people usually come to me and ask about companies like Annaly is why? Because it pays a very, very high dividend yield. So if you're looking for a high dividend yield that isn't just, you know, for lack of a better word, designed to lose money over the long term, EPR could be a good alternative. It has an 8.3% yield. It pays monthly dividend payments. So it's a mortgage REIT like dividend that also has the upside potential of a real estate business. It is an experiential REIT. It owns theaters. It owns eat and play businesses. Top Golf is one of its largest tenants. It owns attractions like water parks, ski resorts. Vail Resorts is a big tenant, and a few others. It has an educational properties portfolio. Um, the recent results have looked strong. It's bounced back from COVID very well. Uh, One of its biggest tenants, Regal Entertainment, declared bankruptcy last year. That was resolved favorably for EPR. It was able to increase its dividend. It still has a pretty low dividend payout ratio. So it's able to fund all of its near-term development and acquisition obligations without taking on more debt or without issuing shares. It has $78 million of cash on hand, an untapped $1 billion credit line, which it can't really use the whole thing right now, but that's okay. It's kind of in a holding pattern when it comes to acquisitions. It has about 137 million in debt maturities this year, but it could fund that with the cash on hand and the cash flow it has that it doesn't have to pay out as dividends if it wanted to. So it really doesn't have that much refinancing risk. It has the liquidity to do that. EPR, they plan to acquire about $250 million worth of properties over the next 2 years with just the cash flow that they're bringing in. So I kind of like that about them, that they're not really, a foot on the gas with growth right now and have an alternative plan. There is a nice long term opportunity here. In simple terms, they need lower interest rates to be able to really grow again. Um, and who knows if and when that's going to happen anytime soon. Like Tyler said, I don't see short term borrowing rates in the 0% ballpark anytime soon. But even 2 percentage points lower than the current environment would make a big difference for a lot of these REITs we're talking about. So I'm a big fan of EPR, big part of my portfolio, a little over 8% yield. Uh, Tyler, you have a fun one that I want you to talk about now. Looking forward to it.
Sure. So it's in the mortgage business. It's the Federal Agricultural Mortgage Corporation, also known as Farmer Mac. So if you know Fannie Mae, Freddie Mac, well, this is the rural development farm and ranch loan equivalent to this, which is known as Farmer Mac. It's the same idea. It's a business that provides liquidity. Excuse me, to it's a government mandate, government services entity, and its mandate is to provide liquidity to the rural communities of America, either through USDA approved loans, ranch loans, as well as things like rural electrification projects. And basically, if a bank writes a loan that is eligible, be USDA farm eligible and meets the underwriting criteria, Farmer Mac says they'll buy it, and they'll either hold it on their books or they'll bundle them into securities and then sell them to somebody else, and will get a servicing fee for the security. So it's not too dissimilar from Annaly Capital, but instead of Annaly Capital buying mortgages from Fannie and Freddie, this is basically like the farmer version of Fannie and Freddie. Now, it's a very, very simple business. It's very it doesn't look overwhelming. Like, net interest spreads are not fantastic. They're like 1.5% compared to good banks will probably get 3%. But because it doesn't have deposit or flight risks, because it just owns mortgages and takes out loans, it doesn't have that kind of like liquidity problem events that you would typically have. And the underwriting is extremely conservative. I know there's the term bet the farm, but farmers are super conservative. They don't take out a lot of loans. Most of the loans that you actually see in the farm world are like 40 to 5% loan to asset value versus like mortgages, which can be typically in the 80% range. So it gives you an idea of like how conservative the underwriting on this is. Cumulative over the life of this business, it's had a delinquency rate of 0.1%. It's incredibly low. And so, you don't have these, issues of like large loan losses that could lead to portfolio issues. It's only like a 3% yield. So like, I know it doesn't have that double digit yield appeal that, so many other people would be looking at mortgage REITs for. But this is a business that's grown its dividend on an annualized basis at almost 25% for the past decade. Over the past 10 years, it's raised its dividend by 900%. So you might not get the yield now, but because there's so much dividend growth and expected dividend growth in this business, that you're more than going to make up for it versus something with a high yield now that could possibly get cut in the future.
Yeah, I wanted to briefly share a screen with everybody to kind of put what we're talking about into context. This is a 10-year chart of Annaly, the mortgage REIT. So the blue line is the actual stock price. You can see it's down about 60% over the past 10 years. And like Tyler said, that includes a period right over here where interest rates were really favorable for mortgage REITs, and it still didn't really do that well. And the top line is total returns, including dividends, 36% total return over a 10-year period. I would not be very thrilled if I made that investment, Tyler. I don't know about you. It's roughly, what, 1/6, 1/7 of what the S&P 500 returned over the past 10 years. So I am a fan of either of these two other stocks ahead of mortgage REITs. So thanks for joining us, and I hope you enjoyed. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.